In the last two videos of this partnership transition series, I covered the main changes both in compensation and taxation when you become partner in Big Law, and how these changes impact your personal finances. Well, I hate to break it to you, but there's one more big change looming: your benefits. See, the main reason for all these changes is from an IRS standpoint, you go from an employee to a business owner. And as a business owner, your benefits look a lot different because you own the place. In this video, I'm going to break down the main changes that will happen with your benefits, as well as introducing new savings opportunities that you will gain. By the way, if you want to watch the first 3 videos of this partnership transition series, I'll link them in the description below. For those of you who don't know me, I'm Joel, your Big Law money guide. I'm married to a former Big Law attorney, and I've educated hundreds of attorneys on the topic of personal finance. So follow along if you want to make smarter financial decisions. All right, let's get into it. One of the biggest changes that happens when you transition to partner in Big Law is that your benefits are no longer subsidized by the firm. As an associate, you pay a portion of the benefits, and then the firm pays the other portion. Typically, we see a 20-80% split. So you pay as the associate only 20% of the premiums for those benefits, and then the firm picks up the other 80%. Now, as a partner, it would make sense to subsidize your benefits because you're the owner, right? So it would come out of your profit distributions or draws anyway. So you would be subsidizing your own benefits. So it wouldn't make sense. So as a partner, your benefits are not subsidized. Now, keep in mind, this is not true for income partners, right? Because the income partners kind of get the short end of the stick. They don't get the subsidized benefits, but they also don't share in the profits of the firm. So some firms like Kirkland & Ellis have actually come out with special stipends for new partners to help offset the higher premiums and the lack of profits distribution. So keep that in mind. So if you have a family and maybe some kids, you can expect your premiums to be between $2,000 and $3,000 per month. So we're talking $30,000+ a year for benefits. Now, it might be a little bit cheaper if it's just you and your spouse, or if it's just you by yourself, but that's a good ballpark to estimate. Now, as a partner, you also lose access to some benefits that you had as an associate. For example, your healthcare and dependent care flexible spending accounts that you loved as an associate are no longer available as a partner. Now, you can still do an HSA or health savings account as a partner, and you can take the dependent care tax credit on your tax return, but you can no longer make those pre-tax contributions to those accounts. And other pre-tax benefits like commuter stipend or pre-tax parking are also no longer available to you. That said, you still have access to some really important benefits like long-term disability, group life insurance, and actually you get new benefits that a lot of firms will either make you pay for or pay for it for you, which is umbrella insurance, which is extremely important, especially when you're making high dollars like Big Law partners. It'll depend whether the firm actually pays for those benefits or if they just make it mandatory. I've seen some firms make you purchase life insurance or make you purchase umbrella insurance. Some firms pay for it for you. It just depends on where you are. So you need to ask your HR team to figure that out. Now, you may be asking, will these benefits premiums at least be deductible? And the answer is yes. Now, they are not pre-tax on your paychecks, right? Because you no longer receive a paycheck. You just get draws like we touched on in the second video of this series. Check it out below if you haven't watched it. So your benefits on your paycheck will not be deductible then. That said, you can deduct them on your personal tax return when you file your taxes the following year. You just include those in Schedule 1. This is where you put your health benefits like medical, but also your HSA contribution, 401k, employee contributions, etc. Now, the nice thing is as a partner, since you're a business owner, you can also take other types of deductions that you weren't able to take as an associate, like your cell phone bill and unreimbursed travel expenses, things like that. Again, you can deduct those on your personal tax return. Now, I get this question a lot. Is this true even if I'm an income partner and I'm treated as a W-2 employee? The answer is no. If you transition from senior associate to partner, but you're still treated as a W-2, which a lot of firms are starting to do, then everything stays the same as if you were a senior associate. Only your title changes. So you can still do tax withholdings on your paychecks. You can still do pre-tax contributions to your 401k. Benefits may still be subsidized. Now that might be a firm-to-firm thing, but nothing's changed as far as structure from when you were a senior associate. Bottom line is you can expect to pay $10,000 to $20,000 more for your benefits than you were as a senior associate. So even though you got a promotion to partner, you may be taking home less money than you were as a senior associate. All right, you might be thinking, this really sucks. And I get it. But thankfully, it's not all bad news on the benefits front. As a partner, you now have access to 2 new retirement plans that are only available to business owners. So we'll dive into that next. Most big law firms don't provide a match to their associates' 401ks. Now, you might be thinking, no big deal. But when you're making multiple 6-figure income like big law attorneys, we're talking $10,000+ a year in lost benefits. And compound that over a 30-year career, that's over $1 million. Thankfully, when you make partner, you have the ability to make up for that lost benefits with 2 new retirement plans. The first one is a profit sharing plan, and those are typically attached to the firm's existing 401k. In a 401k, there are 2 types of contributions, or 2 buckets. One is an employee contribution, and the other one is an employer contribution. Well, as a partner, you're both. So you get to contribute both sides of the plan. The total that you can contribute to a 401k plan in 2025 is $70,000. That's an IRS rule. And the employee portion of that is $23,500. That means as partners, you can add another $46,500 as a profit sharing contribution. And a lot of firms make this profit sharing contribution mandatory. Although I see some firms like Kirkland & Ellis giving the partners a step into this plan where you only have to do maybe a quarter of the full $46,000 in year 1, and then half in year 2, and then the full amount in year 3. And those typically come out of either your profit distributions if you're an equity partner, or your bonus at the end of the year. Your employee contributions will typically come out of your partner draw. But bottom line is you got a budget for an additional $46,000. You're going to get that money back eventually in retirement, and you'll get a little bit of help with taxes this year. But that's still a big chunk of change that you got to find in your budget. The second one is a cash balance pension plan. These are technically pension plans, but they really act like 401ks. So you contribute money to them, that money grows over time, and then you can take it out in retirement either as a lump sum or as an income stream for the rest of your life. The main differences are that, one, the contributions, because it's a pension plan, are mandatory by the partners each year. And number 2, you don't actually have an individual account within that plan. All of the money is pooled together, and you have a small share of that whole pool that is allocated for you. There are 2 components in the cash balance pension plan that allows the money to grow. Number 1 is the pay credit. So that's a predetermined amount that is based on how much money you make, so your income and your age. So the older and the more money you make, the more money you have to contribute in the plan. So if you're a 40-year-old partner making $750K, you may only have to contribute $45,000 each year to the plan. But if you're a senior partner, 60 years old, making $2 million a year, you might actually be obligated to contribute $150,000 a year into the plan. The second component is an interest credit. So think of this as the rate of return on your investment. And there's usually a maximum credit and a minimum credit. So for example, if the pooled money in the cash balance pension plan earned 10% in 1 year, while you may only be capped at 7%, and the rest will be saved to compensate for bad years. But if you do have a bad years, maybe the investments in the fund return a -5%, while you have a floor of maybe 1%. So that balance grows each year. And then at retirement, you can either take it out as a lump sum or turn it into a stream of income for your retirement. Now, if you leave your firm before retirement, you have a couple of options. You can either roll it into an IRA or roll it into your new firm's 401k. All right, so in the previous section, we discussed how your benefits could increase by $10,000 to $20,000 when you make partner. Now, couple that with the new profit sharing, the mandatory profit sharing contribution, and cash balance plan, you could add another $40,000 to $50,000 in deduction from that. So no wonder new partners feel broke in their first couple of years after making the transition. So what's the actual impact of these changes on your cash flow? A few months ago, I built a cash flow projection for a client who's making the transition to partner this year. because we wanted to see the impact that it would have on her cash flow. Here's what I found. Going from senior associate to partner in Big Law can actually be a pay cut. That's right. After factoring taxes, higher benefits costs, and mandatory retirement plan contributions, new partners can actually take home less income than they were as senior associates. Let me show you what I mean. So what you're seeing here on the screen is a comparison between the take-home pay of a senior associate and a junior partner. So the first thing I did is I assumed there was a small increase in salary. Now, for most firms, it's actually not a huge increase. That is no longer on the Cravath scale. So it really depends from firm to firm, but I just assume a small, modest increase. Now, if you go one line further, the total tax, right? So that is calculated or estimated based on the 2025 tax brackets. And it's also assuming that this attorney is married, has a couple kids, and lives in a state with no state income tax. So that's the difference between the total tax for a senior associate and a junior partner. So obviously, you're making more money, you're paying a little bit more taxes, but also there's a self-employment tax that's layered in there, as well as the new multi-state tax filing requirements for partners. The second thing is the 401k and the profit sharing plan, right? As a senior associate, the only thing you can do within your firm is the 401k, which is $23,500. Now, as a junior partner, you now have access to the profit sharing component of the plan. So you can put an additional, or not you can put, you are mandated to put $46,500 on top of the $23,500. So that's why you see the $70,000 here. And the last thing is the benefits. So here you see the difference in the cost of the benefits between a senior associate, where benefits are heavily subsidized, and a junior partner, where benefits are not subsidized at all. And I also added the full HSA contribution to that bucket as well. So after factoring everything, you can see the take-home income for a senior associate is $380,000, and for a junior partner is $319,000. Right? So that's more than $60,000 difference when you go from senior associate to junior partner. So that's a big deal. No wonder why some junior partners feel broke after making that transition. As you can see, making partner can have a major impact on your cash flow, but you shouldn't see it as just a negative thing. Your income trajectory will soon far outpace the small setback that you may have initially. Plus, all the money that you're forced to put into your retirement accounts, well, eventually you'll see that money back, and you'll be glad that you did that for yourself way back when. But that doesn't mean that you should just do nothing and deal with the quote unquote pay cut. That's why in the next video of this partnership transition series, I'm going to talk about some strategies how you can mitigate the impact of these changes on your cash flow. So I'll put the link in the description below. And if you're approaching partnership and you want guidance on navigating all these changes so that you can focus on your life and your career as opposed to becoming an expert in all this, I've included a link in the description below to schedule a free introductory call today. Thanks for watching, and I'll see you in the next video.